do, and they are very, very clever at this, is they make sure that they have monthly dividends coming in that they then align and assign to their monthly debts. See, as we've discussed so many times in the Ask the Wiz Wealth Institute, you have to do an analysis to find out how much it costs to be you. You have to break that thing down, how much it costs to be you per day, per week, per month. Then, the revenue and income stream that's coming in from your portfolio, your investments, should be able to satisfy that particular debt service. Now, write this down. When you add up all of your debts per month, I'm talking about everything from your cell phone bill to your mortgage, all right? Everything that you pay out every month, and then you put plus or minus in there, your food and clothing and things like that. Now, when you get that number, plus or minus, that you spend out every month to be you, to sustain you, that's the number that it costs to be you on this planet every month. Now, follow me closely what I'm about to say. All right? Now, you take that number, and if you are very, very conservative, you multiply it. Listen now, it's an inverse relationship. You multiply it times 5. So if X is the amount of money it takes to be you every month, then you multiply it by a factor of 5 if you're conservative. Listen to me now. If you are more liberal with your thoughts with regards to your ongoing capacity to generate revenue and income to cover the cost of being you, then you use a multiple of 3. Get it? So if you're a more liberal thinker, multiple of 3. But if you're a more conservative thinker and you really, really want to make sure that you are covered come what may, then you take the cost of being you and you multiply it times 5. All right, that's per month now, per month. Now, you take those two numbers, the number that is generated by and through by the multiple of 5, or the number that is generated by and through the multiple of 3. And then you look at your portfolio. Now, the strategies and techniques that you implement every day, every week, and during the month should generate revenue and income equivalent to the multiple number times 5 or the multiple factor number times 3. Get it? So your strategies and techniques should be aligned as the month goes on, from days to weeks to the end of the month, to validate that 3-time multiple or that 5-time multiple, depending upon what it costs to be you. Now, it's very, very simple. We have so many strategies and techniques in our arsenal that, say, for instance, you're starting through the first week, and you're looking, and you see now what others see eventually. You know how much it costs to be you, right? Because you did the numbers. Now, if after the first week, you see that your portfolio is not going to generate, say you come in at a multiple of 3. You see that portfolio is not going to generate the multiple times 3 number. If you utilize the same strategy the first week going into the second week, then what you do, you adjust it. You go back into our arsenal. You pull out some more ER residual strategies, or you lean more heavily on the economic calendar report, okay? Or whatever the case may be. If we have a beta day or max 7/15 day, you go in and you actualize and monetize those positions intraday moving forward. Okay? So that at the end of the month, that factor, be it 3 or 5, your portfolio has generated that number for you. You with me? You control that. We give you what you need to achieve those factors, be it 3 or 5, but you got to go ahead and implement them. You've got to make them work. Now, one of the principal ways of doing that is via having, monthly dividend paying positions. Now, while wagering on the next big thing always drives new players in the financial markets, as you grow in your investment journey, beloved, you'll realize and you'll understand and understand the importance of diversification. I spoke about that earlier at the opening of this Class Without Walls radio broadcast. Specifically, your active positions will likely generate the most gains, but you'll often find yourself with duds. We all do. On the other hand, monthly dividend stocks can give you a consistent stream of passive income. Now, in today's hyper-competitive and hyper-superficial world, everybody's pushing to be the alpha. Everybody wants to be the top whatever. Now, it's nice for a while, but you'll soon realize that there's always somebody out there who's bigger, faster, and stronger. So it is the same with the equities markets and folks waxing poetic about seeking alpha. If it were so easy, wouldn't it be called securing alpha? This is where the monthly dividend stocks enter the frame. And to be clear, there's no such thing as a risk-free investment. That's why we seek to minimize our investment. Our risk. We seek to minimize our risk. Okay? But pick the right monthly dividend stock, and you'll probably have a higher chance of accruing something. On the other hand, if you're consistently seeking speculative growth names, and chances are that over time you end up with plenty of red ink in your portfolio. In that case, you would have been better off investing in dividend-bearing companies. But monthly dividend stocks provide another element to the passive income proposition. Usually dividends are paid out on a quarterly basis or semi-annually basis. However, our bills don't come quarterly or semi-annually, now do they? They come monthly. Therefore, a company that pays out 12 times a year is much more aligned with our daily lives. And so, yours truly has done the homework so that you can pass the test as it relates to monthly dividend paying positions. Now, I've got a list here of dividend-paying positions that pay out dividends monthly that you may want to consider for possible inclusion to your portfolio upon completion of the appropriate drill down. Add these positions to the other positions that I've given you in the past. But before we dive in, okay, I want to make sure that you understand and understand the importance of analyzing these particular positions in your overall plan to be able to provide the amount of revenue and income needed to be you times a multiple of 3 or 5. Okay? Let us go to work. In no particular order. First position I want to give you is a company called Agree Realty Corporation. Agree Realty Corporation, symbol ADC. Now, when the novel coronavirus first touched down on American shores, the quickly unraveling crisis devastated the retail sector, with several state governments imposing a shutdown or non-essential activities on all non-essential activities. Many shopping centers suffered badly. You expect the fallout to hit Agree Realty Corp particularly hard, given that it specializes in such businesses. Fundamentally, though, ADC stock has weathered the storm quite well. In 2020, Agree rang up top-line sales of $248.6 million, up almost 33% from the previous year's tally. Net income was $91.4 million, up 14% from 2019's results. Now, part of the company's success is due to its wide coverage area, with properties in every state in the continental United States except Montana, Wyoming, and Vermont. Okay? Moreover, Agree's clientele heavily features essential businesses such as grocery stores, auto parts, and repair stores, and big box retailers. Therefore, ADC stock performed fairly well based on the circumstances. Now, Agree is one of the monthly dividend-paying stocks with a forward annualized dividend yield of about 3.72%. Okay? Once again, Agree has a forward annualized dividend yield of about 3.72%. And it pays its dividend out monthly. Next position, talk about monthly dividend payers now. AGNC investment, symbol AGNC. Now, AGNC is a stock that has a forward annualized yield of about 8.58%. That's a juicy figure, okay? Now, at the end of the day, AGNC is a stock. When you look at it and you really go ahead and drill down on it, it's a stock that carries significant risk. There's no doubt about it. However, the agency MBS refers to its entries such as Fannie Mae and Freddie Mac to stabilize AGNC. Now, this might be enough for intrepid investors who are dead set on seeking monthly dividend stocks. But I want you to understand and overstand, okay, that if you lived through the last housing crisis or watched the movie The Big Short, you tend to have a guttural reaction to the acronym MBS. Okay, and that is understandable, because that was an entity or shall we say, an investment project, talking about mortgage-backed security. That's what MBS stands for. Okay, that's the acronym for MBS. That caused a lot of problems when the real estate bubble burst. Okay, this particular company, AGNC, does a lot of management of mortgage-backed securities. All right? So, trust your gut feeling, your third eye and your third ear when you're thinking about this particular position, because it predominantly focuses on agency mortgage-backed securities. We're talking about an AGNC, but it pays an annualized yield of 8.58%, but one of the reasons why that yield is so high is because the risk associated with AGNC. Next monthly dividend payer I want to give you is Dynex Capital, symbol DX. Now, this is another internally managed mortgage real estate investment trust. Dynex Capital is perfect for those who want extra oomph in their monthly dividend stocks. Now, of course, higher yields almost always means what? Higher risk. Now, forget Dynex well-manicured marketing statements regarding management of a, quote, a diversified, high-quality, leveraged fixed income portfolio, end quote. Okay? At the end of the day, forget all that fancy talk. At the end of the day, drill down on the performance of the stock. Now, if you want robust monthly returns, okay, then this is speaking Dynex language. DX is a stock symbol. It has a forward annualized yield of about 8.4%, which is a healthy figure. Now, to get to this level of passive income, Dynex focuses mostly on U.S. government-backed agency MBSs, once again, mortgage-backed securities. However, the company also dwells into non-agency mortgage debt, which is the wild, wild west of the debt market. So now let me give you a word of caution now on Dynex. Just because a government entity backs an MBS or mortgage-backed security doesn't necessarily make it safe, beloved. For instance, note that real estate loans have been declining while prices in several metropolitan areas have been rising. This doesn't appear to make too much sense, does it? Which may pose problems for mortgage-related real estate investment trusts. So I'd be remiss if I didn't tell you that, because a lot of you would just be focusing on, wow, you know, they're paying an 8.4%, okay, forward annualized yield, okay, and I want some of that. But look, you need to look at the whole story, all right, and be cognizant of the word of caution that I just gave you, which was what? Just because a government entity backs an MBS or mortgage-backed security doesn't necessarily make it safe. For instance, note that real estate loans have been declining while prices in several metropolitan areas have been rising. All right? Okay. Next position I want to give you is Armor Residential REIT, symbol ARR. Now, if you really want to dial up the risk to get maximum reward for your monthly dividend stocks, Armor Residential Real Estate Investment Trust makes a strong case for itself, featuring an approximately 9% 0.84% forward annualized yield. This stat alone is going to draw some eyeballs for ARR stock. Nonetheless, you're going to want to do your homework as in tons of due diligence. First off, ARR stock has been performing well as of late, up 27% over the trailing 6 months. But compared to where shares were prior to the pandemic, ARR is down about 40%. Second, while the company suffered a hefty revenue loss in 2020, that was understandably due to its subterranean first quarter in 2020. Over subsequent quarters, ARR has been steadily gaining traction. Like other real estate investment trusts, ARR is tied mostly to government-backed mortgage debt. But what you have to watch out for, beloved, is that ARR is also exposed to either hybrid adjustable rate or hybrid mortgages, period. And they also are exposed to adjustable rate loans. Now, because of the fragile nature of our economic recovery, along with the huge conflict brewing with China, adjustable rate anything is a serious concern that you need to take into consideration. Okay? Armor Residential REIT, symbol ARR. Next position I want to give you is Broadmark Realty Capital. Broadmark Realty Capital, symbol BRMK. Now, this is a hard money lender specializing in construction loans for real estate investors and developers. And BRMK also offers commercial and land loan services. Now, BRMK stock will be an enticing name for those seeking out monthly dividend stocks, as it features a forward annualized dividend yield of about 8%. But as I've mentioned, high yields often entail high risk. So what's the deal, the real deal on Broadmark? Let me give it to you. On the positive side of the spectrum, Broadmark has exposure to multiple states in the Sun Belt, such as Texas and Florida. It reaches also into states that are popular with millennials, such as business-friendly Utah, and also states like Colorado. Indeed, BRMK stock should benefit as the states where the underlying company does business represents the forefront of the demographic migration, which the novel coronavirus helped accelerate due to work-from-home initiatives. And then on the not-so-great side, broader economic viability is a major question hanging over BRMK stock. As you might imagine, construction projects aren't particularly robust during recessions. Further evidence shows that construction spending for commercial projects has softened because of the pandemic. But as the pandemic begins to lessen, shall we say, a bit as a result of the vaccination programs rolling out, construction spending should increase, which will help BRMK stock. Last but not least, the position I want to give you, I'm going to give you two more. Next position I want to give you is Pembina Pipeline. Pembina Pipeline, symbol PBA. Now, this is a Canadian company that specializes in transportation and storage infrastructure for the oil and natural gas industry. And Pembina Pipelines suffered a catastrophic loss when the coronavirus hit North America. With lockdowns being the favored mitigation protocol, demand for oil simply cratered. At one point, albeit very briefly, oil prices dropped below zero. That did something to help people's perception of PBA stock. Now, the narrative has shifted much more favorably. On a year-to-date basis, PBA stock is up almost 21%. Further, new investors are undoubtedly keeping tabs on its forward annualized dividend yield of about 7.15%. Now, while it's not quite as high as the other monthly dividend stocks that I presented to you, it's arguably a tad less risky. Once the economy fully reopens, people will need crude oil products. They don't absolutely need home mortgages right away. Once again, position is Pembina Pipeline, symbol PBA. And the last position I want to give you, we're talking about monthly dividend paying stocks that will get you PAID and aid you in the monthly expense of being you, the cost of being you, is Cross Timbers Royalty Trust, symbol CRT. Now, as the name suggests, Cross Timbers Royalty Trust conveys net profit interest in royalty and overriding royalty interest properties of oil projects located in Texas, Oklahoma, and New Mexico. And similar to Pembina Pipeline, Cross Timbers took a beating in early 2020 when the coronavirus struck the United States and beyond. However, unlike other oil-related investments, CRT stock made a relatively quick comeback. Over the trailing year, Cross Timbers shares are up 72%. Despite the robust gains, CRT provides solid passive income relative to many other monthly dividend stocks, with a forward annualized yield of about 5.19%. Now, CRT stock could represent an excellent contrarian take on a full reopening. Moreover, the Suez Canal crisis involving a stuck cargo ship, did indeed cause prices of oil and some other commodities to go up briefly, and any type of supply chain disruption will cause commodity prices to increase. However, it's important that we see substantive and holistic economic improvement, beloved, not just for white-collar workers. If we don't get such a recovery that might engender social fissures, perhaps a repeat of last year's summer of unrest may present itself and cause prices to pull back. But as it looks right now, CRT is poised to do well as the economy seems to be poised to do well. You've just been given multiple positions, 7 in total, that pay monthly dividends that command our attention as it relates to looking at them as possible sources to add revenue on an ongoing and consistent basis to our portfolio to offset the cost of being you, me, we, the beloved ASK THE WIZ Wealth Institute family monthly. We're talking about that Agree Realty Corporation, symbol ADC. AGNC Investment, symbol AGNC. Dynex Capital, symbol DX. Armor Residential REIT, symbol ARR. That's Armor Residential REIT, symbol ARR. Broadmark Realty Capital, symbol BRMK. That's Broadmark Realty Capital, symbol BRMK. Pembina Pipeline, symbol PBA, and Cross Timbers Royalty Trust, symbol CRT. All very, very robust companies that will get you PAID and add consistent revenue and income coming into your portfolio that will offset the cost of being you each and every day, each and every week, each and every month.